Hey, welcome to Full Count. We're doing a recap for 2022, how the stock market reacted, and how housing has also, have adjusted just because of the whole mortgage rate situation. We'll also talk about some features about homes that aren't as popular anymore because of the fact that personal savings rates have plummeted. Three balls, two strikes, pressure is on. This is where we discuss real estate, property improvement, and business. Together, we'll strategize on how to win. Welcome to the Full Count.
All right, Andrew. Well, what are we talking about today?
There's a lot to cover today. We're going to be talking about how Americans are feeling during this time now that things have definitely changed and shifted to more of a recessionary time in terms of the stock market, real estate, and other things as well. So there's a lot we can get into today, and I think the point of today is mainly to equip people with information, and we can explain and agree to disagree on certain things. And in terms of that too, I think what's important is I was seeing how there's like this guy named Patrick Bet David and then some other very well-known people how they have said that generational wealth disappears after two generations, and after three, it's even more so. So I think the more we all kind of know a little bit about finance and things in current events, I think the better and more equipped we are as people to flourish.
Yeah, no, I definitely agree. Just the one bit on that though, right? When uh, from what you're quoting, so is that if the two and three generations afterwards just live off of that wealth that was built by that one person and basically not build anything else?
Well, it was just saying statistically that that was like a matter of fact of how it
Okay.
goes down. 70% of the time after two generations, that wealth that was built pretty much evaporates. And then 90% of the time after three generations, it evaporates as well. But it didn't really give that
Hmm.
qualitative data that you're asking. It just
Right.
specifically gave that data. But I believe a lot of that is also due to how your mindset is and how organized you are and how you kind of take over the business. Because we all see very well known people like the Vanderbilts will start something and then their generation of people kind of loses it, unfortunately. Um,
Yeah.
so that's kind of what I'm getting at. Because like for example, when I grew up as a kid, I come from a middle class. I think you do too, right?
Yeah.
So my dad
You could
would do these
call it that, I guess.
I mean, my dad would do these meetings with us as a family unit where we'd get
Yeah.
together and he would, after dinner sometimes too, we would talk about, our lives, how school is going and, how we can kind of help one
Mhm.
another with whatever issues we have. When it came to finance, though, we didn't really talk about that except, very bare minimum things, which I think in some cases is very important. People miss out on as kids. But we talked a little bit
Mhm.
about credit cards, saving, and that was it. Very
Yeah.
surface level things, but I think for me, as I get older, if I were to have kids, I think I would definitely want to, hunker down and really teach the children about finance to mini
Right.
levels, right? So that's kind of why I'm
Yep.
doing this, talking about real estate, business, and whatever comes about.
Hmm. Yeah, that way you don't have to be like me growing up and my parents were, I mean, especially my dad, always, got to watch what you're spending, got to watch what you're using, always got to be mindful of things. So that way you don't have to worry about those things.
I think that's a good thing, right? In a way.
Uh, yes and no. It depends on, how you take it. I mean, I obviously went to finance and taught myself personal finance and all of that. So I know better now, right? But I mean, growing up, it was like you always you want to be mindful with your money, but then there's a certain point, right? Where you want to watch what you're spending, but then you also want to be able to enjoy yourself and not have to worry every 5 seconds about what you're using, what you're spending, how many times you're flushing the toilet. You know what I mean? Like what degrees the freaking air conditioner is on, like 2 degrees here, 2 degrees there.
To a degree, I think that is like, I think that is helpful. I think there's like layers or levels, I mean, to it. So like, level one, save and watch your cost and be mindful of credit cards. Level two, it can go to invest and things like that. Invest in assets. What's the difference between assets and liabilities? But I can see what you're saying with that. Sometimes we can go a little too extreme and be too
Too
afraid
much.
to spend our
Right.
money.
That's like the immigration mentality too, you know? Like when my great
Right, right,
grandparents
right,
immigrated over, they had a watch because they had nothing, But then that was passed down and even when you did have something, yeah, it's still having that mentality isn't necessarily great.
I'm glad you brought that up too about the immigration mentality. I think that is true in the case because I was watching a video with forgot his last name. His name's Robert though. He's on Shark Tank. We'll talk about this more
Oh
as we go
yeah.
through the
Hmm.
video podcast. He basically said the immigration mentality is to never leverage your money for the most part, pay
Right.
everything in cash, pay your cars in cash, pay your houses in cash, and things like that. So I can
Hmm.
see where you're getting
Yeah,
there.
he's one of my favorites. I actually saw him speak live at one of the events I went to,
Oh,
and I
cool.
think yeah. Say what?
Or when? Recently or how soon
No, this was
ago?
I don't know. This was before COVID. A little
Okay.
before COVID. I think like 6 months, a year before COVID, or something like that.
What did you get out of that speech?
I mean,
Like, what
he
was it?
he is big on like what you said on the immigration mentality, kind of where he came from, and being able to make something for yourself, for your family, for generations after that, just by being strict with yourself and actually pursuing something and just keeping at it, failure over failure,
Mm.
till you make it. So he's very big on that, and he's also his personality. I mean, you could see him on Shark Tank, right? I mean, his personality is very down to earth. He relates to the
Right.
everyday kind of people, yeah. Whereas like some of them are they're a little too high on their horse sometimes. So
Yeah, like Robert, I think you're right because Robert, I can see myself like being around, on a personal level or a
yeah.
business level. But like Mr. Wonderful, Kevin O'Leary,
I mean, don't get me wrong. He's great. He's great.
I think like Mark Cuban and Kevin O'Leary would be amazing to hang out with. But
Yeah.
for a while, you're like, all right, dude.
Right.
You know.
Exactly. Exactly.
So with that said, let's talk about the personal savings rate because personal
Hmm.
savings rate has definitely hit its lowest from what I saw on the Wall Street Journal and other places as well.
Hmm.
Gone to the lowest level since like 2005, which was 2.1%
Right.
in 2005 personal savings rate. Now it's 2.3%, and basically that just means like once you have all your cash and you subtract all your expenses, what you get left over with it. That's a
Hmm.
percentage left over with. During the pandemic period, when everyone was kind of locked down and things like that, the personal savings rate, exponentially exploded. Considering you're not driving, you're not overspending on going out, dinner,
Hmm.
whatever. It was around 33%, but now it's at 2.3%. I just find that not good,
Yeah.
obviously.
Well, like the piece of the article that you sent me, right? So
Right,
the way we're defining personal savings rate is a measure of how much money people have left over after spending, their personal spending as well as their taxes, right?
right.
So it said that it fell to 3.1% from 3.4% in August. And this was, do you remember when this article was? This piece that you sent me a couple of days ago, maybe
No,
mid
I think
December, early December.
November,
Oh,
maybe November.
November.
Yeah, I think it
Okay.
might have been November. So that's why the
Okay.
statistics are a little different, maybe.
Yeah, yeah, maybe because it says from this was from 7.9% a year ago.
Are you
So
sure you're looking at the personal savings rate?
yeah, it says personal
Okay.
savings rate. Yep, fell to 3.1% from
Oh,
3.4
yeah,
in
yeah, yeah.
August.
It said in April of 2020 it was in the 33% range of some sort. 33.8, I think it was.
33.8.
Yeah,
It's a big difference.
look it up online in the meantime just to make
Okay.
sure we're.
Yeah.
But it was
Putting
33.
accurate facts out there. Well, well.
No, it was 33.8% from what I saw in the Wall Street Journal, maybe 4 or 3 days ago.
Oh, okay.
In 2019, the personal savings rate, obviously before everything went crazy, was around like 7.6%, which is obviously much better than the 2 or even 3% range. But I don't think we're going to see a personal savings rate remotely close to what it was in 2020, according to that stat being at the 33.8%
Hmm.
range. But um, unless the culture completely changes and Americans, believe in saving again and investing, but I don't think that's the case. I
Right.
think we're always going to over leverage ourselves on things that maybe not are the best, you know, things to spend money on, things like that.
Yeah. So this says, uh, according to So this is Y charts. So the personal savings rate is at 2.4% currently, and this is December, compared to
Okay.
2.2% last month and 7.1% a year ago.
Okay.
Yep.
Got it. Okay, cool. So that's what I think that's kind of the case then, because my data might be more current in terms of the 2.3%
Yeah.
versus your 2.4. Not to get like into all the details of that, but I find that important, obviously.
Hmm.
But yes, 2020 it hit like 33%. Obviously, as times have been getting more difficult and the stock market's been changing and real estate, everything, Bitcoin imploding, the personal savings rate has been tanking. So yeah, I could see that. You
Hmm.
said a year ago savings rate was 7%.
Yeah. Yep. Just about.
Okay.
But I
Got
mean,
it. Now that makes sense.
that goes along the lines with inflation increasing, right? Consumer goods increasing. People have to spend more money to basically sustain their lifestyle that they were before,
Right,
right? So they're
right.
able to save less or having to pull out from what they have saved up. So
Sure.
makes
Well,
sense.
what I saw too is 90% of Americans believe we're going to hit a recession next year.
Hmm.
Um, I think they're probably right, obviously, but a lot of that also could be because of what they hear on social media with their friends and all the chatter and the noise. Because sometimes people can lead themselves into a recession just based off of perception. Let's say
Right.
there's no recession in fact, but everyone's thinking about it. So what do people do? They stop spending a little bit
Yeah.
less. They stop investing. They start stop going out. But I think in this case, I think that's more than likely we'll probably be in going into recession more than likely. But nobody knows exactly until we're into it for 2023 sometime of this quarter
Hmm.
coming up.
Yeah, I'm glad you
I think that
mentioned that though, because it is definitely there's a big psychological aspect, right? I mean, if you look
right,
at
right.
sociology and the study of groups, you could see that, right? If people think and they're kind of perceiving that something's going to happen, then it usually does because they base their actions on that, and it's kind of what's the term I'm looking for? Perceived, uh, like you're basically writing your fate on the wall. I
Uh,
forgot what the term is for it,
I
but
don't.
there's a term for it.
I get what you're
Um,
getting at, though.
yeah.
Not cognitive dissonance, right? No,
No, no.
that's something else. Okay. No, I
Yeah,
don't.
I'll think
Like,
of it. Give you like 20 minutes. I'll be like, oh, by the way.
what's that?
Oh, no, I said, give me 20 minutes and I'll think of it. I'll be like, oh, by the
Oh,
way.
got it. What was the other stat we saw that was interesting? Was in terms of trying to see here. It was the National Retail Federation, how they estimated that 1.4% of the revenue that they receive has been due to theft. Overall, most of that statistic of
Mm,
1.4% of the revenue in total across the nation has been because of all the theft going on, which
mhm.
equates to about $94.5 billion, I think it was, which is
Yeah,
crazy.
that's what it was, yeah.
And I have my own thoughts on why that is the whole theft. Considering criminals may feel more confident that the legal system might not go after them necessarily. I know in California at one point, I don't think it's this case anymore, but if you stole $900 worth of whatever type of good and you stole it, as
Mhm,
long as it's under that bracket, you're not necessarily going to be arrested or get legal ramifications, really. So
mhm.
my point with bringing that stat up though is what they were saying in that stat was they're probably going to see a bunch of retail companies, the groceries and things like that. Their prices are going to go up even more because obviously they're losing money,
Yeah.
and that just sucks for
Yeah,
Americans.
so just to clarify, we were talking about shrinkage, right? So that 94.5 billion is the
Right,
amount of shrinkage in inventory. So shrinkage is a term for loss of inventory,
right,
in the retail industry. So they were saying that it amounted to roughly 1.4% of retail revenue in 2021, which is the 94.5 billion. And that most of it was caused by theft. So not all of it, but most of it. Others could be like
right.
uh, bad products or returns that were
Yeah.
open, whatever it was.
My point with bringing that stat up though is what they were saying in that stat was they're probably going to see a bunch of retail companies, the groceries and things like that. Their prices are going to go up even more because obviously they're losing money, and that just sucks for
Yeah.
Americans.
Yeah, so just to clarify, we were talking about shrinkage, right? So that 94.5 billion
Right.
is the amount of shrinkage in inventory. So
Mhm.
shrinkage is a term for loss of inventory
Right.
in in the retail industry. So they were saying that it amounted to roughly 1.4% of retail revenue in 2021, which is the 94.5 billion. And that most of it was caused by theft. So not all of it, but most of it.
Right.
Others could be like uh, bad products or
Yeah.
returns that were open, whatever it was. But I mean that makes sense because things are getting more expensive. People are more prone to steal, right? They're looking to get something for free. Yeah,
Fortunately, yeah, I think
or
that's what
they
people.
can't afford it and they gotta live.
Yeah, that sucks for those people, obviously. But there's way of getting what do you call that? Like food stamps
Hmm.
and things like
Yeah,
that.
there's
But
government
there's some
programs.
people, yeah, there's people in the middle that don't fall in each category, which really
Hmm.
sucks. But either way, though, like that shouldn't be an excuse for someone to go out
Oh
and
no,
steal.
yeah.
Obviously,
Yeah, there's no excuse
um,
for it. And I mean, some people, probably the majority of them, I would say. I mean, I could be completely wrong on this, but I would think the majority of people that do steal are stealing to resell it and make a profit on it, on whatever it is.
I can see that with like jewelry, clothing, but I
Yeah.
don't know about grocery. I think they're
Hmm.
taking it for themselves,
I
obviously.
mean, if you go, you get it for
Um,
free, and then you go to, a low income area and you're selling groceries. Hey, I mean, even if it's produce, you're making a profit, right? It's for free.
Arbitration,
Yeah.
right? Or no, not arbitrage.
Yes,
I think it
exactly.
is. You buy one type of good in a given area, and then you take it to another location
Mhm,
and you sell it.
mhm.
More. But either way, I mean, I hope those people get caught because that
Yeah,
obviously sets a precedent for Americans, to steal more, and that's obviously not
right.
good. But either way, the moral of that story is that sucks. Why does that suck? Because now, more than likely, according to retailers, they're going to bump up the prices and make it even more costly for Americans that are law-abiding citizens, and that's obviously going to pressure in a little bit to inflation.
Mhm. Yeah, because somebody's gotta pay for it, right? And it's usually
Right.
the
And that's
consumer.
gonna right,
Mhm,
right, right. But leading into that, CPI came out for November at 7.1%, which is great because we're starting to see it soften. It was at 9.1% around June, I
mm,
think, uh, or maybe a little after. But either way, it was at 9.1% at one given point, and it's been slowly kind of falling month over month. And hopefully, we see that continue to fall because when CPI falls, mortgage rates tend to fall too.
mhm,
The reason why I bring that up too is even though inflation is coming back down, according to the stat I was reading, 12% of goods in
mhm,
groceries have still gone up and they're not going down. So
mm,
even though inflation's coming down, doesn't mean every particular department or industry is correlated with it. Some are still going to stay
right.
higher. That makes sense.
Yeah, so there's actually an
Like
interesting concept. So if inflation goes down and
cheap.
say the value of the dollar, right, becomes I don't think this is necessarily gonna happen. I don't think this ever happened in history. Maybe it has. I don't know. Correct me if I'm wrong if you know. But the value of the dollar becomes stronger, right? But prices stay high. That means they're even more expensive.
The value of the dollar gets
Right.
stronger, and what?
The prices of consumer goods stay high. So say if something's worth, something right now is priced at $4 at the value of the
Right,
dollar as it is now, right? Now the value of the dollar
right,
increases. So that dollar is supposedly worth more. So say it's you could buy maybe it's worth like $5, a $5 good item, right? But
hmm.
prices stay high. Does that necessarily make the price of the good even more expensive? Or am I just completely out there?
I don't necessarily know. I understand. I think I understand what you're saying, but I think we'd have to look back at the inflation crisis during the late
Hmm.
1970s and
Hmm.
early 80s. How inflation skyrocketed,
Hmm.
right? But I don't know if the value of the dollar also skyrocketed
Mm,
upward. I would have to check on that stat. I
okay.
don't know.
Okay. Yeah, and I guess that kind of gets into like foreign exchange and currency and all that.
Well, the thing is, the dollar's always
Yeah, right,
fluctuating, right? They're
exactly.
like the stock
Mhm.
exchange. So uh, dollars are weaker, sometimes are stronger, and sometimes it's better to be weaker, the U.S. dollar, and sometimes it's better to be
Right.
stronger. Uh, like a strong dollar is good for us as Americans, but when it comes to like purchasing items that are being
Mhm.
imported, right, from other countries, that tends to get even more expensive because those nations tend to have our currency as a reserve currency for them. So when they're paying back their debt in U.S. dollars, it's more
Right.
expensive because the dollar is getting more expensive, so their debt is getting more
Mhm.
expensive. So it's a very complex thing, I guess you could say. And at that point, I think we need a like an economist
Yeah, I
to
was
kind
just
of
gonna
come in.
say
But
that's
even
kind of
then,
a separate topic. Get into
right,
that for a
right,
while.
uh, right. But that's why I think it's good, even during inflationary times. Although I think it's probably going to soften in the next 4 or 5 months,
Mhm.
hopefully. Regardless, it's always good to invest in some type of asset, so your dollar per se is going up with that asset,
Mhm.
right? Rather than just taking the money and leaving it without it growing any type of interest rate of
Right.
any
No,
sort.
I agree. I agree. That's why Jared and I are closing on this investment property. It's supposed to close in 2 weeks.
Did you guys have a date?
Yeah, yeah, we got it. It
Nice.
needs little bit of work, not too much, nothing major. And we're just getting everything in line and in the process. And we close in 2 weeks. So hopefully, knock on wood.
Good for you. So I'm glad you're out there still, with that mindset to
Hmm.
buy. I mean, Jared knows what
Yeah,
he's doing. I'm
exactly.
sure that'll help more
Right.
confident too.
Yeah.
Some people have gone on the sideline. When I say people, buyers have gone on the sideline real
Hmm.
estate because they're afraid of what's happening,
Yep.
right? So, um,
Yep.
speaking of real estate, I think we should go into that. According to the National Association of Realtors, the median house price across the nation is now $370,000. It's up 3.5%
Mhm.
for November statistic year to year, but at the same time, we're seeing a softening in prices as well. So, I think that's has to do a lot with interest rates
Mhm.
going
Mhm.
going up higher. And fortunately, now that CPI is going down, I think mortgage interest rates are probably going to come down with it a little bit. More than
Mhm.
likely, the home prices will soften a little bit more. And at one point, once we get around 5.5% mortgage interest rates, hopefully, or lower, I think prices will start to come back up.
Yeah. I mean, I think that's probably a good like stabilizing point, right? Around 4 or 5%, and it stays pretty stable, Because I mean, if you look at like some of the history where the mortgage rates are around that range, then you see prices kind of stay within a relative range as well,
Right,
you know.
right.
So, and I mean, the mortgage interest rates went up, but now they have come back down a little bit. Like I think
Yeah, I
we
think
locked in like 6%. So,
you locked in 6%. That's
hmm,
really good.
hmm,
Because right now, okay,
yeah,
so like a week ago, it was like 6.25. After like
right,
3 days ago, it was like, again, I'm not a lender, a mortgage lender. I'm not licensed for that. I can't
hmm,
really quote rates, but I'm just kind of speaking opinions and kind of what I recall. But a couple days ago, the mortgage rates, or even today, I guess, was 6.4 to 6.5%. They kind of went up recently.
hmm,
Uh, but
hmm,
it's always fluctuating. But yeah, you're right. I think because mortgage rates are going down, demand is going to start coming back up. Hopefully, that mortgage rate continues to slide downward rather than
right.
back up. But I think it's good. At 6% is a really good deal that you got.
Yeah, yeah. No, I'm glad we we were able to get it because this was 2 weeks ago. It was 6%, and then the end of November when we were in contract with another property that didn't end up working out, it was 6.25. So, and like you said, it kind of
Okay.
went up a bit after that and then came back down. Yep.
Right. Right.
Do you want to
That's good.
touch on
Uh,
some of those?
the Case
Yeah.
Shiller Price Index. Let's talk about that. So that came out for October. They're 2 months
Hmm.
behind. What we recall, what we saw there, based on the stat, I'll read it here. It's let's see here. Home price index for October, it went down in October 0.5% nationally, but it's still up 9.2% year to year from October of 2021. At one point in March of this year, it was 20.8% at the peak
Mm,
in March. Prices have declined countrywide 3% across the nation. And in terms of the 10 to 20 Case-Shiller index for like the more metropolitan areas, we've seen an even deeper decrease rather than 3%. So it's now at around 4.6% home price decline from the peak of like March. So we definitely have seen a little bit of a little shave off the top in terms of home prices, but again, it all relates to higher mortgage rates when they hit 7 to 7.5%. In some cases, it was even 8% in 2022. Now we're looking at the low sixes,
mhm.
and hopefully, as the year proceeds into 2023, hopefully first quarter or second, we'll see it around five and a
Yeah.
half or so.
Yeah, that'd be nice. Uh, yeah.
It'd be really nice. Yeah. And then if prices were ever to, I mean, not prices, but mortgage rates were to come down even further, I don't know if they would come down that much, but let's say it comes down to 5% or 4.5%, then you can always refinance your
Yeah, exactly.
6%
That's what
loan.
Jared and I were figuring. I mean, as long as it makes sense with, paying for closing
I don't
costs
know
and
how long
all of
it'll
that, you
take.
have to factor that in, but
You got to do
yeah,
the break-even
exactly,
points and
exactly.
whatnot.
But just on that note, so I mean, kinda to pivot that's related to that, the value of the US single family housing market, the trend graph that you had sent over, I did find pretty interesting, and I think if rates did, drop, we would see that debt line increase, and as it compares to the amount of home equity that's out there, we'd probably see that gap close, but I don't think it would be such a rapid decline as with the last housing bubble in the 2008 financial crisis.
Right, right. Because, I mean, what do we have here in the stat? Let's see. Um, 28% decline in home prices took place in 2006,
Hmm.
2009. So it's set about 11 million homes below their mortgage
Right.
balances, right? So basically underwater. In December of 2022, CoreLogic said home prices would have to fall about 45% from their peak, so from like March 2022, to be in proportion to the mortgages underwater back in '06 to '09
Hmm.
period. So, we really need a drastic reduction in home prices from the peak to really get to that point. And I think that's why we're not really seeing that probably going to
Hmm.
take place. I did a video. I don't know if you saw around the summer. I mentioned just based off of this statistician and
Hmm.
economist in Florida, who their professors. I utilized their charts and kind of did my own little spin on it, and I saw that in Southern California, prices could fall as much as
Hmm.
12%, if get worse. But besides that, I don't think we're going to see anything really above 10%, where prices for homes would
Hmm.
necessarily come down. I think, but I'm speaking for
Right.
California. I'm not speaking nationwide. Nationwide, that's a
Right.
different story.
Exactly. No, I mean, I agree with that. I think the average nationwide would be somewhere around 10%. I don't think it would be, yeah.
Oh, okay.
Yeah,
Speaking
no,
for
no, no, I know,
California, though.
I know. But I mean, I think California would probably follow the average more or less, just because it's a very
Okay.
high demand market, you know? It's a strong market.
Well, yeah, it's a strong market. I mean, the toxic mortgages don't
Mhm,
exist like they did then. No income, no asset situation. The vetting from lenders is very difficult now in terms of like getting a loan. If you're trying to be a sleazeball about it, you're not going to get it. They're not going to give it to you. Here's a statistic from Stephen Thomas Reports, who does this like housing reports. He's a statistician. He's not a realtor, but a statistician. He put and I don't know where he got this data, but I'm sure it's legit. Maybe CoreLogic, I don't know. But it says in California, 89% of homeowners who have a loan are enjoying a fixed rate at or below
mm,
5%. And then he went even further. 71% of homeowners in California have a 4% mortgage
mm,
rate or lower. So that tells you right there. I mean, 89% is a
mhm,
ton, even 71. That tells you that if those people still have a job, which I'm sure they probably will, but even in a recession, they always
Change.
can
Yeah.
wipe them out of a job. That tends to be more in the service industry, but who knows? These people could
Right.
be in the service industry too. But the point of what I'm getting at is people are not going to want to sell their home. Majority of those people, that 89%, are not going to want to sell their home with a fixed mortgage
Mhm.
interest rate under that. So, with that being said, there's not going to be a whole lot of supply or of inventory
Mhm.
going out
Mhm.
into the market
Right.
in
Right. I mean, I think that's also applicable nationwide, you know? I mean, people with a lower
Probably,
mortgage
yes.
rate, they're not gonna wanna sell it
Right.
and have to buy something at a higher rate, you know? I mean, if they own it cash and outright, that's a different story. And I did find that
Yeah.
statistic that you sent over really interesting that, 39% of single family houses in the US are owned, or have a mortgage.
Fully.
Or no, sorry, free and clear, right? Yeah,
Right. 39%. I think it was 37 or 39% of all homeowners in the country
right.
do not have a
Yeah.
mortgage. They
So
own
that's
it
just
free
a
and
little
clear.
over a third. That's a
That's
lot.
another. Yeah. I mean, uh, if things really got really bad, I mean, and prices really fell, it would have to. That's why that
Mhm.
statistic I was saying, prices would have to fall 45% home prices in order for you know people to be underwater on their
Right,
mortgages back in like
right.
'08 or '09.
Agreed. So
Yeah. But inventory still, that whole concept of inventory is a big thing. I think the existing home sales, I got the stat too. I think it might have been by MBS Highway, but inventory is about
mhm,
1.14 million today, and about 35% of that 1.14 million homes on the market. So yeah, 35% of that is in escrow. So a lot of those homes are not touchable. The other ones
mhm.
are actually for sale. Back in like 2008, there was 3.7 or 4 million homes for sale rather than the 1.14 that I just mentioned. So again, inventory would have to
Yeah.
explode for things to get really bad. So I think people that are listening and watching can be more so rest assured it's probably not going to get as bad as they would expect. And it would really have to get so bad that everything we own evaporates in terms of
Mhm, mhm.
value. So I
Agree.
don't
And
think
I
it
mean,
gets that.
you could see it. So we'll put this up on the video, but by that trend graph that you sent over with the debt and equity trend lines, I mean,
Hmm.
the equity trend line would just have to plummet and plummet quickly, right? For people to go underwater. Because it's at what the debt line now as of what is this? It looks like maybe July or August of 2022. Maybe this is from right. The debt,
You know what?
yeah,
I don't
yeah,
have
but the
that one.
debt is at just about 13 trillion.
Well, let me read this to you. From the Urban Institute, the data they
Hmm.
released. This was back in June, though. They said mortgage debt was 15% higher than in end of 2007. So the mortgage debt is 15% higher as of 2022 than in '07. However, I mean that obviously sounds not
The
probably
equity,
good, but the total equity is 131% higher
right?
today than it was back in '08 or '07. So that's a pretty big difference
Yeah,
of equity. There's a lot of equity that these homeowners have to play with in case they can't make payments. They can always refinance and tap into that
exactly,
equity to save
exactly.
them,
Hold on one
so they
second.
don't have.
I have to get my charger from my computer.
Right. Okay.
Sorry, I thought it was plugged in already.
While
No, it didn't have me.
let's talk about some features in homes though that are not as popular as they were back in
Hmm.
2021 or even earlier in 2022, which was pools and all these patios and things like that. Basically, things that homeowners love to enjoy, but it may not necessarily be something that's completely in use that you need right now. Right? These are more like things just to have.
Yeah,
It's nicer and it's more fun to have. But um, based on the Wall Street Journal, they were saying that new construction for pools have dropped 10 to 15% this year as opposed to last year. So not as many people are installing pools anymore. I mean, it was a hot thing to have, during the social
Mhm.
distancing and all this extra money people had and things like that. But now people are not spending as much as
Right.
they used to, and that kind of goes to the whole recession concept. And yeah, I think that's really interesting. And I'd love to
Yeah.
hear what Steven has to think too. I think we'll have him on next. We can see what he says about all building out all these
Right.
fancy patios that people do and installing pools. I know, Nick, I mentioned to you this actually with Stephen on
Mhm.
when we were talking about remodeling, how these features of homes, the popularity tends to
Mhm.
plummet when a
Exactly.
recession
I mean, it's
comes.
because it's one of the first things to go because you can live without it in your house, right? I mean,
Right,
it's more of a nice to have than need to have. You need to have a kitchen, you need to have a
right,
bathroom. You don't need to have a pool, you don't need to have a, a jacuzzi, a sauna, cold plunge, whatever it is. Um, but that article that you sent over, the Pool Corp article, I did find interesting because they were talking about how the some of the statisticians were lumping pools in with in-home gyms with portable hot tubs, things that you can get rid of, right? Whereas a in-ground built-in pool you necessarily
right,
can't get rid of, and that it wasn't those in-ground pools weren't necessarily giving back the amount of equity that they used to into a
right.
house, right?
Yeah, I mean, I think people just need to really cut back if you don't have the funds or you don't believe you have the funds in the next year or two. I think definitely hold back and maybe not spend the money because, like you said, it's just nice to have. It's not a necessity per se.
Mhm.
But I'd
Right.
like to know what that statistic comes out to later in 2023. I would believe it's going to fall a little bit
Mhm.
further. So, if you invested in a pool company, a stock, you might want to reconsider that. But who knows? It might bounce, it might hit a
Mhm.
bottom and it might start bouncing back. Who knows? But now that we're talking about stocks
Yeah.
or things like that, I think we should get into it, because the Federal Reserve raised Fed funds rate 50 basis points in December of 2022. So now it's ranging 4.5% Fed
Mhm.
funds rate, which are those short term rates, right? And that affects loans all across,
Mhm.
the board. With that said, stocks haven't been very good this year. They said that the stocks have been lower this year. I mean, not lower. They're similar in terms of percentage downfalls as it was back in 2008.
Mhm. Hmm. Okay. So, I mean, is that showing a
I
similarity?
saw
Like a very, very close similarity, do you think? Do you think it's a big leading
of
indicator?
what
Yeah.
I think so. I mean, there's a lot of other things at play that are leading
Mhm.
indicators, like the inverted yield curve. 3 month yield to the 10-year yield is
Mhm.
inverted, so is the 2 to 10. That usually tends to be a leading indicator. The manufacturing index that I've heard of too is down. So that tends to be a leading indicator. Housing is technically in a recession in terms of
Mhm.
the home buying and volumes has been going down too. So yeah, I think we probably are,
Right.
if not in a recession already. But I would never be the one to say, "Oh yeah, we're definitely in a recession," because I don't know. I don't think most people really know, except some experts. But what sucks is when it comes out the word that we're in a recession, they tend to say, "Oh, we were in a
Yeah,
recession
right,
four or
because
five
they don't
months ago."
wanna
Now
have
we're
people
saying,
panic like anything else, you know? Like, they
right,
they're not gonna tell
right,
you, "Oh, a meteorite is coming to hit the Earth." They'll tell you, "Oh, 2 months ago, the meteorite almost hit the Earth." Tell you after the fact, because then people panic, and
right.
then you're prone to get into a recession or whatever it is. Yeah.
Even
Mhm.
more, yeah, like we were saying earlier. Um, but like I think definitely the higher ups, the elites of some
Right.
sort, definitely they know for sure. Um, the people that are on the
Mhm.
Bloomberg
Mm. Well, the
terminals, they know
investment
too,
bankers.
right? Normally,
Mhm.
right, right. Rule of thumb is 2 consecutive quarters that are negative
Right.
GDP tend to be a recession. But yeah, NBERS, I forgot the name of it, but they're an organization that actually looks through all the data and then they
Mhm.
basically mention if you're in a recession or not. But going into stocks real quick, the year to year, from the beginning of the year to now, the Dow has fallen 8.78%. The S&P 500 has almost fallen 20%, and then the Nasdaq has fallen
Mm.
27.65%. So obviously,
No.
people's portfolios is not good. I know we did a recap the first and
Mhm.
second quarter, as you recall, Nick, in 2022. We were saying how stocks were probably not looking good based off of what we read, and there was some optimism out there, but unfortunately, the data says it all,
Mhm.
and stocks have not been good. Tesla's down, I think, like I don't know, 70% or maybe close to 70% from
Mhm.
the start of the year. So
Yeah.
uh, it's kind of scary out there, especially like Go and
Yeah,
Bitcoin being
exactly.
down
That's
so
why I
much
followed
as
Robert
well.
Kiyosaki's advice and invested in real estate instead.
He was talking about it because that imploded.
Yeah, yeah. I didn't see him talk about crypto or Bitcoin.
He talked
Um,
about
but just your point.
He talked about Bitcoin a
What?
lot. Because he's a big advocate of gold, real estate, of
Mm,
course. And then at one point, he was,
yeah.
in 2021, he was talking about invest in Bitcoin, yada yada. Although I'm not investing in Bitcoin, I
Okay,
think
I
it
didn't
can
see
be
that.
good, but unfortunately,
Right.
people invested at the peak, even when it hit 60,000. Now I think it is 16, eighteen
Hmm.
thousand. Um, but in any
Right.
case, do you remember the whole concept of FANG stocks? Now
Yeah, yeah. So it was, what is it? Facebook,
Amazon,
Amazon,
Netflix, Google. I think
Netflix,
I was
Google.
watching
Yeah.
on Twitter. I saw a tweet by Ross Gerber, who's the CEO of the financial group,
Hmm.
or he's one of the founders of it, Gerber Kawasaki, and he was saying how it's no
Hmm.
longer FANG, it's now TAM, which is Tesla, Alphabet, Microsoft, and Netflix, which I found pretty fascinating. That
Yeah. I don't. Yeah, yeah. When you sent that over to me, I don't know. I don't necessarily agree with the whole Netflix piece of it. I mean, yes, Netflix is big. Everybody's, was home watching Netflix. Their stock rose, but I mean, it's come down quite a bit
go with
now.
the
And I don't know. I just
stock
don't see it being at that level with
But
them.
they keep making great content. I think that's what he meant. And the future might
Oh
be
yeah,
in
like
movies.
Netflix
Yeah,
inspired
rather than
movies.
box office. But you're right.
Yeah.
Netflix has fallen 50%
Hmm.
from the start of the ton. That's pretty
Hmm.
bad. Not
Yep.
as bad as Tesla, but I
Exactly.
still think Tesla's probably the better stock to invest in for EVs.
Yeah. I mean, if you got to pick probably any of the like car manufacturing companies, that's probably, one of the top one. That's probably the top one right now,
Yeah.
at least.
By the way,
Um,
it
but
was
I still.
NBER. I forgot what the acronym stands for. That's the organization that evaluates all the data to determine whether it's a recession or not. So
Uh-huh.
NBER, National Bureau of
Okay.
Economics, something about.
Okay. Oh, yes. Got it. Okay. Interesting. Well, we'll see what they say 6 months from now, probably.
Right.
But just the point on the stocks, right? I know you mentioned that a lot of people were hurting, but people that are probably or that are hurting the most are the people who are just now going into retirement, right? Because I mean, I know a number of people who have just recently retired or are going into retirement, and they were banking on having so much more in their 401k and their portfolios to be able to live off of, right? And now they either got to continue working at their current job, right? I mean, I think everybody should do something even after they retire from their career job if they do have one. But they might have to still stay at that job and continue their career because of how much of a downturn the stock market has taken. And if they want to be able to sustain a certain lifestyle, then that's what they have to do,
Right.
you know?
Yeah, it's unfortunate. Some people get out of retirement.
Hmm. Right. The people who are just turning, 65,
Right.
67, then they're hurting now. So that's why you just don't know. Like when you get there, you put all this money into your 401k, your Roth, your other stock investments. And when you get there, if things have a huge downturn, you have no choice
That's
but
really
to keep working,
unfortunate, and I
right?
think that Americans, and what makes it even
Yeah.
more um, difficult and kind of sad too is AI is like replacing a lot of jobs. So a lot of those more so easier jobs on the body, maybe even on the
Mhm.
mind per se, that aren't as complex that maybe people in their older age want to go into to do to pay the bills. They can't really do that, especially as time goes by.
Mhm.
But that's why I think it's so important to invest in like real estate. And I know I keep pushing real estate because I'm a realtor, and I know that kind of, I have the incentive to push it. But I think the reality is real estate is really important because you can rely on that cash flow, and cash flow is key to live out
Mhm.
your life more comfortably, like Guy Kawasaki and Grant Cardone. Even though I don't agree with Grant Cardone a lot on things, but
Right.
I do agree with that. But there's also like cash flow you can get from stocks that pay a dividend, right? So it depends. As long as you can
Yeah.
find a way to
Exactly.
get cash flow, um, I think that's really important. Uh,
Yeah. I mean, I think the biggest takeaways are is
right,
you want to be diversified, right? You want to have investments in
right.
different areas with different assets. So I think that's the main take home point, right? Have some in stocks, have some in real estate, have some in, a business or a number of businesses that you've started that eventually are able to run on their own or with minimal amount of
Mhm.
your time, you know? And that way all those different avenues kind of give you
Right, and
income.
I think that's why it's crucial to some degree,
Mhm.
take that risk to find a way to diversify and really find a way to get that cash flow so you can live a more comfortable life as we age. Because as I was saying this, a story
Mhm.
earlier about Grant Cardone and Robert from Shark Tank. Robert was saying that immigration mentality
Mhm.
is to pay everything with all cash, right? He was saying to, I guess he used an example when
Yeah.
he was young, or maybe his parents came. I think it was more, but there was like if you have $100,000, right? He has $100,000 and a friend has 100,000. He would always ask his friend who decided to pay the house in cash, a hundred
Mhm.
thousand dollar home or $200,000 home, where you already paid 50% off. Why not, if you have the means, buy $1 million home
Yeah.
as an example? I think that's a bit of a extreme example. Buy $1 million house, leverage your money. Now you can get a more expensive asset. You end up putting, or not putting, but you end up seeing an
Mhm.
appreciation over 20 years or whatever. Let's just say at the bare minimum, that $200,000 home you bought
Right.
has only gone up $40,000, right? You spent that $100,000. But if you spent $100,000 and bought $1 million home, that 20%, I mean, that 10% increase has gone up 200,000. So that's how you really leverage your money. You put that money down, maybe you leverage it a little bit more than someone else. And if you play it out well, you end
Right.
up seeing a higher return than if you play it safe, especially when you go into multifamily and rely on
Mhm.
cash
Yeah,
flow
you
versus
leverage
like
other
a
people's
single
money.
family home.
I mean, that's the case with real estate. I don't know if you follow Pace Morby, but he's huge on that. Buying real estate with no money down or seller financing or a number of different avenues. Highly recommend, looking into them if you haven't. Um, but then I mean that also goes.
That's why it's crucial to some degree, take that risk to find a way to diversify and really find a way to get
Mhm.
that cash flow so you can live a more comfortable life as we age. Because as I was saying this, a story earlier about Grant Cardone and Robert from Shark Tank. Robert was saying that immigration mentality
Mhm.
is to pay everything with all cash, right? He was saying to, I guess he used
Mhm.
an example when he was young, or maybe his parents came. I think it was more, but there was like
Yeah.
if you have $100,000, right? He has $100,000 and a friend has 100,000. He would always ask his friend who decided to pay the house in cash, $100,000 home or $200,000 home, where you already paid 50% off. Why not,
Mhm.
if you have the means, buy $1 million home as an example? I think that's a bit of a extreme example. Buy $1 million
Yeah.
house, leverage your money. Now you can get a more expensive asset. You end up putting, or not putting, but you end up seeing an appreciation over 20 years or whatever. Let's just say at the bare minimum, that
Mhm.
$200,000 home you bought has only gone up $40,000, right? You spent that $100,000.
Right.
But if you spent $100,000 and bought $1 million home, that 20%, I mean, that 10% increase has gone up 200,000. So that's how you really leverage your money. You put that money down, maybe you leverage it a little bit more than someone else. And if you play it out well, you end up seeing a higher return than if you play it safe, especially when you go into multifamily and
Right.
rely on cash flow versus like a single family home.
Yeah, you leverage other people's money. I mean, that's the case with real estate. I don't know if you follow Pace Morby, but he's huge on that. Buying real estate with no money down or seller financing, or a number of different avenues. Highly recommend looking into them if you haven't. Um, but then I mean that also goes to the point of businesses, and if you're starting your own business or you're involved in a startup, using investor funding to fund your business and getting it started, right? Or and that
Right.
might free up some of your time once that gets started, not having to put as much capital towards that, to also maybe start another business or invest in another real estate opportunity, whatever it might be.
Right. Right.
Pace Morby.
What was that guy's name though that you mentioned?
Morby, yeah.
Pace
Yeah,
Morby. He says
he
0%
yeah,
down,
he
or you can't.
look him up and you'll see. He has so much content. He has so much content. It
I don't
is.
know if that's a
Yeah,
good thing.
it is. Just look him up.
I'll look that up. That no, no, no. But I mean, I'll look
Mhm.
into it and we can go back to this conversation with that. But I think 0% down is kind of leading into
Mhm.
potential issues, kind of like in 2008. Because you have
No, he
seller
buys it
finance.
seller financing
Oh,
with
that's
nothing
better.
down. But he has a number of different
Got it.
real estate purchasing uh like
Okay, seller
methods that he
financing. Yeah,
teaches.
that's another story.
Yeah. And
Okay.
that's just
What
one
I
of them,
also recommend people
right?
watching and hearing too is I have it on my Twitter, Andrew A. Vargas, by the way. Uh, give that a follow. But you guys should
Mm.
all follow or look up when you can. It's a friend of mine actually showed it to me, Miguel. He's a realtor too. It's Secrets of Old Money. So 500-year families at 500-year family. Basically, it kind of goes back to what we were talking about, the legacy of wealth building, right? So he gives a lot of advice on how to go about that, and how it's important to have meetings with your family, talk about finances, lead the young generation to kind
Mhm.
of move forward and better understand and use it as an instrument with that. But I think 0% down is kind of leading into potential
No, he
issues,
buys
kind of
it
like in
seller
2008,
financing with
because you have
nothing down. But he has a number
seller
of
finance. Oh,
different real estate purchasing
that's better.
uh like methods that he teaches.
Got it.
Yeah. And that's just one
Okay,
of them,
seller financing.
right?
Yeah, that's another story. Okay. What I also recommend people watching and hearing too is I have it on
Mm.
my Twitter, Andrew A. Vargas, by the way. Uh, give that a follow. But you guys should all follow or look up when you can. It's a friend of mine actually showed it to me, Miguel. He's a realtor too. It's Secrets of Old Money. So 500-year families at 500-year family. Basically, it kind of goes back to what we were talking about, the legacy of wealth building, right? So he gives a lot of advice on how to go about that, how it's important
Mhm.
to have meetings with your family, talk about finances, lead the young generation to kind of move forward.
Mhm. Yeah, I mean the personal finance industry is, I mean, bigger now than I think it ever was. I mean, there was a big
Mhm.
need for it before, but now, I mean, you could see so many people that have become teachers or influencers, or just give out, free content, free material on personal finance, right? I
Right,
mean, that's some of the
right.
things that we
But
touch on.
we're also very transparent. Like I can talk a lot about real estate. You can talk a lot about other things in engineering
Mhm.
and project
Right.
management, but we won't ever give advice like what stock to buy and things like that. If that's something we want to talk about in an episode, which we
Mhm.
will, by the way, I would like to bring on a guest who's now my financial advisor at Gerber Kawasaki, and he knows the ins and outs of that. So he's the expert in that. We're the expert in other things, but
Mm.
I wanted to leave people too with a quote that I'm sure you've heard by two people, right? Because we see the stock market's not doing good and probably not going to do too good early 2023, at least the first quarter, but who knows? It might go back up. The point is, though, before I tell you the quote, is at one point there will be a bottom. Most people don't know when it is, and that's why it's good a dollar cost average. And that quote is the following by Warren Buffett. Um, be fearful when others are greedy, and greedy when others are fearful. So basically, when nobody's buying stocks
Mhm.
right now, with Tesla being down, you may want to consider spending a little bit on that stock and
Yeah.
investing because We might be at a bottom. We don't know. And then there's John Templeton, who's another fascinating investor. He said the time of maximum pessimism is the best time to buy, and the time of maximum
Right.
optimism is the best time to sell. So in 2021, when Bitcoin was at its peak and everything was wonderful, and NFTs earlier this year too, or last year, um, you know everybody was in optimism
Yep.
phase, and that's
Yep.
maybe the
Agree.
time
Okay,
to
go
sell essentially.
the opposite of the majority. Like against the grain.
Right,
Hmm. So no, I like that
right.
quote the best. It's one of my favorites. The second one.
Be fearful when others are greedy, and greedy when others are fearful. So basically, when nobody's buying stocks right now, with Tesla being down, you may want to consider spending a little bit on that stock and
Hmm.
investing, because we might be at a bottom. We don't know. And then there's John Templeton, who's another
Yeah.
fascinating investor. He said the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. So in 2021, when Bitcoin was at
Right.
its peak and everything was wonderful, and NFTs earlier this year too, or last year, um, everybody was in optimism phase, and that's maybe the time to sell essentially.
Yep. Yep. Agree. Okay, go
Right,
the opposite of the majority. Like against the grain.
right.
Hmm. So
Which
no, I like that
which
quote the
one
best.
though?
It's one of my favorites.
Oh,
The,
by
the
John
second, the
Templeton.
second one.
Which one though?
Yeah, it's a very good
Oh,
quote.
by John Templeton.
But,
Yeah, he's
all
great.
right. Any other
Yeah.
points you want to touch on before we wrap up, Andrew?
Yeah, I'd like to tell everyone watching and listening, we're gonna have some more guests on for throughout 2023. So it'll be fascinating. We'll have different people on that are experts in their own field, whether it be business or some other type of industry. We'll pick their brains on how they got so successful, what their plans are, and how they excel under pressure. As we know, that's what full count's all about. So we'll ask them their full count moment, and I think it's going to be a good time, and it'll be
Yep.
fascinating to
Sounds
have
good.
people
Yeah, no,
watch
I
and
look
listen.
forward to it too. We get a lot of these conversations as well. So
Yeah, he's great.
yeah,
Yeah.
it's a very good quote. But, all right. Any other points you want to touch on
Yeah,
before
I'd
we
like to
wrap up,
tell
Andrew?
everyone watching and listening, we're going to have some more guests on for throughout 2023. So it'll be fascinating. We'll have different people on that are experts in their own field, whether it be business or some other type of industry. We'll pick their brains on how they got so successful, what their plans are, and how they excel under pressure. As we know, that's what full count's all about. So we'll ask them their full count moment, and I think it's going to be a good time, and it'll be fascinating to have people watch and listen.
Yep. Sounds good. Yeah, no, I look forward to it too. We get a lot of these
All right.
conversations as well. But with that, hope everybody has a good start
All
to the new
right.
year, and we'll talk to you soon. Cool.
All right.
Nice.
Thank
That was good.
you.
Talk to you soon. So, but with that, hope everybody has a good start to the new year, and
All right. Thank
we'll
you.